Right, so this is a continuation from where we left off in the previous week. Right, so we are doing session number 2 today. Right, last week we started on the topic of direct and indirect costing, and I did do a practice question there, right, to introduce our topic. So we just want to continue from there with the direct and indirect. So the question that we did last week, I did indicate that it was an introductory question, right? Eventually, we'll have to do something much more challenging than that particular question, right? So we did two things. Last week, we did the classification of cost, and then we looked at the direct and indirect costing. Right, so maybe what we can do, we can just recap a little bit, especially on the direct and indirect costing. Right, remember we said when it comes to direct and indirect costing, right, we are looking at two methods that can be used to compile income statement in a management accounting setup. Right, so we are looking at the direct, right, and indirect costing. Right, so we said these are methods. These are two methods or options, right, for preparing, right, income statements. Right. If we remember, we also highlighted what we said was the main difference between the two. Who can update us on this one? Right. What is the main difference between the two statements, good people? Just a recap of our work from last week, if somebody remembers. Right, good people, that's for you. Right, so we said the crux of the matter here, right, basically is the treatment of the fixed manufacturing overhead. Okay, right, it is the treatment, right, of the fixed manufacturing overheads. Right, treatment of the fixed manufacturing overheads. So there is a difference in the way in which we treat this. Right, under the direct method, right, also remember the direct method is also commonly known as variable costing. Right, also known as marginal costing. Very important to be familiar with that, right? Because those particular terms are interchangeable. So in one question, they can say prepare a direct costing statement, or they can also use the other names. So we are talking about the same thing. Right here, we are saying the fixed manufacturing overheads are treated as a periodic costs. Right, these are treated as a periodic costs. Right, so when we talk about periodic costs, right, what do we mean by that, good people? What is a periodic costs? Right, good people, are we there? What is a periodic costs? Right, it's a non-manufacturing costs. Right, it's a non-manufacturing costs. Right, and then we're saying this is written off, right, after gross profit. Right, when we talk about the non-manufacturing costs, it's written off after gross profit. Right, or contribution. Right, so which means we only take care of this in an income statement after we already have either the gross profit or the contribution. Right, this is not included, right, in the value of inventory. Right, this is not included in the value of inventory. That's a periodic cost. So this is how we treat the fixed manufacturing cost under the direct method. Right, under the indirect method, what is the other name for this one, good people? Right, the indirect method, what is? Let's mute please. Only unmute. Right. So this is also known as absorption costing.
Tabi?
Right. Let me help this learner. Which one it is now? All right. So here we are saying the fixed manufacturing overhead is a manufacturing cost. Right. We're going to treat this as a manufacturing cost. Right. This is treated as a manufacturing cost. Right. So when we talk about the manufacturing cost, basically, it is the opposite of a periodic cost. Right. It is included in inventory valuation. So when you value inventory, you are going to include all the manufacturing costs. Right. It is included in the calculation, right, of cost of sales. Right. So which means it is included before, or it is included in the calculation of gross profit. So in your income statement, it will appear before you compile the gross profit calculation. If it is a manufacturing cost, if it is a periodic cost, it means you only account for it after you already have your gross profit. So this is the main difference between the direct method and the indirect method. Right, so that we discussed, we then had other minor differences that we spoke about. We said that here, when we do the direct method, we talk about contribution. When we talk about the indirect method, the sister or the cousin of contribution will be gross profit. Right. We also said the indirect method, which is absorption costing, is our basic method or our default method for the purpose of compiling financial statements. So whenever you do your FACs and you are doing an income statement, you always apply the absorption costing method. The other method, which is the direct method, it is used only for management and internal reports. So those are the main differences between the two. Right, we proceeded from there to then do a question. But in that question that we're doing, we did the budgeted income statements. So what we want to do now, we want to do another question, slightly similar to the one that we did last week. But this time we're going to do the actual statement. So there will be slight differences that will occur when you do the absorption costing income statement, if it is actual than when it is budget. So there is something that I want to show you there, which is very important. Right. Any question? I was just summarizing what we looked at in terms of direct and indirect, just to highlight again the main difference before we go to the question. Right. Any question from the floor? All right. Let's go to the question. If you check the groups, I have shared some questions with you. I want you to look at question number 3, which is what we're going to be looking at. So you will see, if you open that particular question and you go to the required, this time we're looking at the actual, not the budgeted. And there will be an impact in terms of how we compile the absorption costing statement. So it says Right, prepare the actual statement of comprehensive income for Sebastian Limited for the month ending 31 January, right, using the variable costing, and then number two, absorption costing. And we do also what we did last week, which is to reconcile the income according to the net income according to the two methods. All right, so let's have our structure here. Right, so our method of teaching will always be like this. We'll introduce the theory, right? We'll do a simpler question first, and then we'll look for complicated questions after. So usually, if time permits, the first lesson on a particular topic will be mostly theory and an introductory topic. And diligent students should then go and cover what would they've covered. And the next section will be a slightly difficult question. Right, let's see. Right, so we want to look at one. We want to do the income statement. Right, for which period? This is for the month ending 31 January 20x8. Right, we're using variable costing. Right, as usual, good people, an income statement, you always start with your sales. Then you say less. If it's variable costing, you should say variable cost of sales. Right, and then from there, you then have your opening inventory if it is there. It's not every question that is going to have opening inventory, but most of the time you have your opening inventory as well here. Right, the calculation of the sales is always easy. That's pretty much it's the quantity sold multiplied by the price. So we need to look for that. So here is the case study. Right, it says here the budgeted results. The budgeted results for the month ended 31 January of the year 20.8 or X8 are as follows. So here we have been given the budgeted information. But remember, on the requirement, we are going to do the actual statement. So what you always need to do when you're doing an income statement, check whether they want the budget or the actual, because the information that you have is adequate for the preparation usually of both. So you need to make sure that you are combining exactly according to the required. So here we've been given the sales, which is 75 million, and there was a sale of 15,000 units. Right, we have the opening inventory, 600 units, direct material, etc. Right, we need to check which method has been used to compile this income statement, people. Right, if we look through which method has been used to compile the income statement. Now remember, as long as you see the term gross profit, and as long as part of cost of sales you see the fixed overhead, then we are applying the absorption costing. Right, the other method, which is the variable costing method, does have instead of gross profit. Right, please mute, thank you. Right, instead of gross profit, we then have contribution, or what we call marginal costing. Right, and also the fixed manufacturing overhead will be expected as part of the periodic cost. So here we have been given a budget compiled according to the absorption costing. Right, let's see additional information. Right, it then says here, number one, the management was informed late in December of the year 20X7 that due to the weakening rand, the material cost will increase by 150 effective on 1 January, and this will be taken into account in the budget above. All the other budgeted costs were based on the actual cost incurred in December. So obviously, when you do a budget, right, you will probably base it on your performance in the month of, say, December here, right, and then you project it into the next month. So we are being given that the budget was based on the actual figures of December, which means the December figures were not expected to change, except for material, right, which has already been adjusted accordingly to the expected or projected figure in January. Now, then they say the fixed overheads are allocated to production, right, based on units produced, right? And then the production for the month of January is 15,300 units. Normal capacity is 183,600 units per annum, and the fixed overhead was budgeted at 385,560 for the year. The actual fixed overhead for January was 33 million. Right, so we are being given information concerning the fixed overhead. Right, we are given the budgeted production for the month, which is 15.3. Right, we are given normal capacity and what have you, but we are interested more in the actual figures. Right, all the other costs for January were as budgeted. The selling price per unit also remained unchanged. Right, in January, the actual sales volume was 10% higher than the budget, and 20,000 units were produced. Sebastian values inventory according to the FIFO method. Now, this is important in terms of the valuation of closing inventory. Either we use the FIFO or we use the weighted. I'm not sure which method we used last week. What did we use? I think we used the weighted average. So between the two, you should be able to see the full picture between the weighted and the FIFO. Right, so we have the information. What I want is the sales quantity. That is what I'm looking for. Right, so they say in January, the actual sales volume was 10% higher than budgeted. So I need to go to the information and find out how many units were actually budgeted for sale. Right, we have 15,000 units here. Right, so therefore, in terms of calculations, right, we can say, right, the budgeted quantity is 15,000 units, right, multiplied by or increased by 10%, so that we get the new quantity expected in the month of January, right? So we then have 16,500. Right, so what of the selling price? Remember, we're looking for the sales. It is the selling price multiplied by quantity. Right, did the selling price change? Right, let's see. I think they said all other information remained the same as per the budget. Right, so this is what they said. The selling price per unit also remained unchanged. So in the previous or in the budget, this is what we're having. Right, 75 million in terms of the sales value of selling 15,000 units. So therefore, we are saying the 75 million, which is the value derived from a sale of 15,000 units, will mean that the price per unit would have been how much after the subdivision? They would have been 5,000. So therefore, right, this is 16,500 units. So we are saying that we now have 16,500 units multiplied by the selling price per unit, which remained unchanged. Right, so which means we are going to have 82500 as our sales value, the actual sales value. Right, any question, good people, on the sales? Are we on the same page? Right, good people, are we on the same page on the sales value?
Yes, we are.
Wonderful. Let's go now to the opening inventory. Right, so remember we have the budgeted information. right, which is based on absorption costing, but we are creating a variable costing statement. So we should be careful about certain things on the opening inventory. Right, remember we have opening inventory 600 units and the value is 2.4 million. So what is happening? Remember, this is based on absorption costing, so it will include the variable manufacturing costs, right, and the fixed manufacturing overhead. Right, here let me just say fixed manufacturing costs, right, because when we say fixed manufacturing cost, we are including the direct material, the direct labor, those are not overheads, plus fixed manufacturing overhead. Then we have the fixed cost. So what is happening now is that in an absorption, in a variable costing system, right, we don't include the fixed manufacturing overhead costs in valuing inventory, but we only include what? The variable manufacturing costs. So what we need to do here, we need to remove probably the fixed manufacturing overhead costs. Right, so remember, um, when we are doing a budget for January, on opening inventory, we are not going to be using estimation, right? Because we have already what? Finished, or we've already gone past December, which is the preceding month before January, right? So we have the actual information for December. We are projecting for January, but on opening inventory, we don't have to project because what is closing inventory in December will be opening inventory in January. So therefore, it simply means these were the actual units that were on hand on 31 December, and this would be the actual cost that was there on 31 December. Right, so what we need to do is just remove the fixed manufacturing overhead. So let's look for information that talks about the opening inventory. Did they say anything on opening inventory? Right, they said that the fixed manufacturing overheads are allocated based on units produced. Right, budgeted production for the month of January was 15,300 units. Normal capacity is 183 units per annum, and the fixed overheads are budgeted at that for the year. The actual fixed overheads for January were that much. Right, all other costs for January were budgeted. Then the selling price per unit also remained unchanged. Right, in January, the actual sales volume was that. Right, so we need to find out for this company to say what is the fixed manufacturing overhead allocating rate per unit. So we need to look for the fixed manufacturing overhead allocating rate. Right, so that we can determine the value of the fixed manufacturing overhead that have been included there. Then we can remove them from the opening inventory. Right, so what we do, remember when it comes to overheads, right, before the gross profit, we use what we call applied overhead, which is based on budgeted information. Right, so let's discuss that. Right, there is a particular thing that we should always remember. Right, when it comes to fixed manufacturing overhead, right, these are not easily traceable. Right, to the final product being produced. These are not easily traceable to the final product that is being produced by an entity. Right, so these are then allocated. Right, to units produced. Right, so with the fixed, with what we call the variable manufacturing costs. Those are specific costs, right? For example, when you deal with direct material, a company does not just buy any material anyhow and stockpiles it. Normally, they will first determine the products that they want to produce, estimate the demand in the market, and then they go and buy the material that is required to satisfy their production need. So when you buy material, it is actually specific to a particular product. You know which product you are going to use the material for. When you acquire direct labor, you know exactly where that direct labor is going to work, which product they are going to manufacture. Right? So you don't have to allocate that cost. It's a specific cost. It goes to a particular product. When you incur it, you know I'm going to be charging it to this particular product or job. That's the variable manufacturing overhead. But the fixed manufacturing overheads are not easily traceable to the final product. Now, these things are usually shared costs. For example, we can give, say, a rent expense, right, where we have a number of products being produced. Right, that fixed manufacturing overhead cost, which is the rent in this instance, if you have three products that you are producing and they are under the same premises, then it's a shared cost between those three products. It is not easy to trace to the final product to know exactly how much should be charged to each product. You need to use some logic and some estimating techniques to then allocate the cost to each individual product. Now, because of that, as you actually produce product, it's difficult to know how much of fixed manufacturing overhead to actually charge to a product. It's different from the direct material. When I'm producing, I already know how much material I put in there on this particular product and how much it costs me to buy. So I can accurately cost that particular expense to each product. But when I've got a premises where I'm producing three products and I've got a rental expense, it is not easy to say, as I am producing a product, this is the correct cost to charge. So what we normally do to then determine the correct or the actual fixed manufacturing overhead costs, what we do is we take the total fixed manufacturing overhead costs. Then we decide on the method of allocating that cost. In this question, they are saying we are allocating the fixed manufacturing overhead cost based on the number of units produced. So therefore, we're going to divide that by total quantity or units produced or output, so that we can then get a cost per unit. Now, this will be a more accurate cost. Right, I'm assuming here that in this instance, we have one product. Even if we have two products, it's still calculated the same way if we're using what is called the traditional method. So we just determine how many products to produce regardless of the product type. So this is the only way that you can determine an accurate cost per unit. Now, however, there is a problem with this. You can only get the total costs incurred by an entity at the end of the year, and you can only know about total output at the end of the year. Right, so that an accurate cost per unit can only be determined only at the end of the year. Right, however, we are saying we cannot always wait for the end of the year to have the fixed manufacturing overhead cost per unit. Remember, if we are using absorption costing, the fixed manufacturing overhead cost will go into the costing of the product. Right, and once we have the cost of a product, we can determine the selling price. We can apply our markup. So we are saying we cannot wait until the end of the year to get this cost per unit, which means we'll have to wait for the end of the year to determine the selling price, which means we should be producing from the beginning of the year up to the end of the year without selling, waiting for us to determine our cost per unit and therefore our selling price. That can't be. When you are in production, as you start at the beginning of the year, right, you immediately want to start to sell whatever it is that you are producing. So we need to find a solution to this. we need to find a way of going around this. So what we then do, we use budgeted information. Right, so what we then do, we then compile what is called the overhead recovery rate. It is also known as the overhead allocation rate. So any of these terms can be utilized. Right, where we then say, right, a total budgeted. So we have to estimate this total budgeted fixed manufacturing overhead costs. Right, then we divide that by the total budgeted output. Right, on this one, let's be clear. Sometimes we use budgeted machine hours. Sometimes we use budgeted labor hours. So when you read a question, they will tell you how the overheads are allocated. If they're allocated based on quantity or output produced, they will tell you. If they are calculated based on machine hours, they will tell you. If we use this calculation, the ORR that we get, which is the overhead recovery rate here, right, will be cost per unit. If we use hours, it will be cost per hour. Then if we want to know the cost per unit, we'll have to determine how many hours it takes to produce a unit. So the ORR now, it will serve as our fixed manufacturing overhead cost per unit. And that's a budgeted cost. Any question on this, good people? Right, I know this area usually confuses students. Any question there? Right, let's go to the question. Right, so what we need to do here, we need to come to the question and say, right, what is our overhead allocation rate? Because what would have been included in our opening inventory in terms of the fixed manufacturing overhead rate would have been the ORR. Right, so we need to then see what the question says concerning this. Right, they were very clear on note number 2 here. Right, where they say the fixed overheads, right, the fixed overheads are allocated to production based on units produced. So we are using output in this instance. And then they tell you the budgeted production for the month of January is 15.3 units. But then they tell you that our normal capacity is 183 units per annum. And then the fixed overhead was budgeted at 385,560 for the year. So what we then do, we then say, what is our total budgeted? Right, fixed manufacturing overhead costs. Right, then we divide that by our output. And then in this instance, if you read through, they gave us our normal capacity. These are the number of units that we normally produce. So therefore, we then divide that by total budgeted normal capacity. Yeah, which is basically our normal output. So we then have the amount of 385,560, right, divided by the output, 183,600. Right, so that will give us our ORR. So 385,560 divided by 183,600. Then we are going to have a value of 210. So this is per unit. Right, so we are saying included in our opening inventory. Right, included in our opening inventory here, right, will be the fixed manufacturing overhead costs. Now remember, there are 600 units all in all. Right, and then there are 600 units all in all. Right, and we are saying the fixed manufacturing overhead cost is that much. So 600 by 2, 1.2, right, which means we have included 1,260 in terms of the fixed manufacturing overhead cost here. Right, then we go and say, that looks very small, that looks very small. All right, I made a mistake. This is 385,560.
Yes, yes.
000 there. So I need to add 3 zeros here. Yeah, because now the figures were not numbering properly.
So it will be 2,100.
It will be 2,100 there. Thank you very much. So we need 2.1. All right, so which means we have 2.1 here. And how much will be this? 12,600 what? Oh, let me calculate. That would be 1,200,000, ne? Right, so this is the figure. So what we are saying is that in our opening inventory, there is a fixed manufacturing overhead cost of that much. And we need to remove it there because we are not applying absorption costing. We are now applying variable costing. So therefore, we need to go back here, right, and say 2.4. All right, so we're going to take the 2.4 minus the 1,260,000, and then we'll have our opening inventory based on variable costing there. Right, so which will give me a figure of 1140,000. Right, let's recap that really. Let's recap that. Right, remember we have been told in the question that we should do an actual statement based on variable costing. Right, however, in the information provided, we have been given a budgeted income statement here. Right, when we go to the budgeted income statement, this is going to be our base because most of the information is going to come here, and you were told that in the question. Remember, this is a budget, of course, but we want the actual. Right, all other costs for January were as budgeted. So therefore, we are saying the budget and the actual, the information is the same in most instances. So we are going to base our actual calculation on the budget. But now we need to look at this budgeted statement and say, is it based on the principles of variable costing or absorption costing? Right, you need to know the structure of an absorption costing statement and that of variable costing. So when we look at the question here, we can clearly see gross profit. You automatically know that this is absorption profit. This is absorption costing as long as there is gross profit. That's number one. Number two, you can check the calculation of cost of sales. You see that they've included the fixed overhead. Right, as long as your cost of sales contains fixed costs, then again it is evidence and proof that you are dealing with absorption costing. So that was the first thing to understand. So once we have that understanding, we then go now when we are dealing with opening inventory and say, right, we have opening inventory of 2.4, which is made up of 600 units. But this was created specifically for an absorption costing system. And then we say, what, by the way, is the difference between the two? Here we included variable manufacturing cost plus the fixed manufacturing overheads. But we know that based on the variable costing system, we should not be including that. So we need to remove the fixed manufacturing overhead cost from that particular figure so that we remain with what is appropriate for a variable costing system, which is the variable manufacturing costs. So that's the first thing, of course, when you deal with this question that you've got to clear. Otherwise, you will have problem if you are not understanding that one. Right, once we have that, then the question now is simple. How do we determine the fixed manufacturing overhead cost here so that we can remove it? We have to understand that what we include in opening inventory in terms of the fixed manufacturing cost, it is what we call the applied or absorbed cost. How do we calculate that? Then we go to the question. We know that whatever fixed manufacturing overhead is included in inventory, it is based on absorbed cost or applied cost. Right? To determine that cost now, we are going to say it is based on absorbed costs on the ORR. So we need to determine this thing called the ORR. It is based on budgeted figures. So you look for the annual budgeted fixed manufacturing overhead cost for the company, and then you divide by a number of units produced if the question says so. Right? How do I know the question says so? When you read on fixed manufacturing overheads, they will tell you the allocating base. So the fixed overheads are to production, or the fixed overheads are allocated to production based on the units produced. This is what I'm looking for. It's not always going to be like that. In another question, they will say it is based on direct labor hours. So if it is based on units, divide by your normal capacity or by the total budgeted number of units. If it is based on hours, divide by the total budgeted normal direct labor hours or by the total budgeted direct labor hours. Here we use normal capacity. So that we then determined that per each unit being produced, the fixed manufacturing overhead cost was estimated at 2.1. Then we say how many units are in opening inventory? There are 600. And the fixed manufacturing overhead included there was what? 2.1, which means that the fixed manufacturing overhead cost total included in opening inventory was 1,260,000, and it should not have been included for a variable costing system. So we deduct that particular figure. Any questions, good people, from the floor? Right, hopefully we are very clear on that. Then we can go now to the other costs. So there is direct material, there is direct labor, and there is the variable manufacturing overhead cost. So I will say direct material, direct labor, variable manufacturing overhead. Right, in the exam, you don't write in shorthand, you write in full. So don't follow what I'm doing on the board there. I'm just being lazy. I should be writing direct material completely there. Now, what we need to see, we can see here that the direct material, there is a figure of 19,125. We need to find out if this particular cost changed or not. Right? If the actual cost is different from the budget. Now, this is what they said. Management was informed in late December 27 that due to the weakening of the rand, the material cost will increase by 150 per unit effective on 1 January. This was taken into account in the budget above. All other budgeted costs were based on actual cost for December. So we are saying our material that we used in the budget had taken into account that material will be expected to be at 150 per unit. Right, but then we want to know how that affects the actual. Here they simply said all the other costs for January 20x8 were as budgeted. The selling price per unit also remained unchanged. So remember, this has been taken into account. This is expected increase in our budget, but we are saying that all the costs for the budget are the same as per the actual. So therefore, we are saying that the cost per unit will remain the same. Remember, this is a direct cost, right? This is a direct cost. We may need to know how many units were budgeted here so that we can actually calculate the cost per unit and then multiply by the actual number of units that were produced in the current period. Right, so what we do, if we go through the question, they gave us the budgeted number of units of production here. That was provided. Right, this is what they say. Right, they say the budgeted production for the month of January is 15.3 units. So therefore, we can come and say the 19,125 there. Right, 19,125. This is the total cost incurred for the production of 15.3 units. So what we get here is the budgeted cost per each unit that was produced. Right, so therefore we get a figure of 1,250. Now remember, we are told this budgeted cost was the same also for the actual production. So what we need to know is what is the actual production, right, for the month of January. We were given that. Right, in January, the actual sales volume was 10% higher than the budget and 20,000 units were produced. So therefore, we are now saying, right, our figure of 1,250, which is the cost per unit, but multiplied by the 20,000 units, which were actually produced. Right, so all in all, we are going to have 25 million. So this is the amount that we have in terms of the direct material. Right, so we do the same for direct labor. Right, our direct labor here is 6,885. This is a variable cost divided by 15.3, which is the budgeted quantity. You then get your cost per unit. Then this time you multiply by the new quantity, which is that much. Right, so that we are now having 9 million. Right, remember we are applying variable costing. Under the variable costing system, we were very clear. We said variable cost of sales. Automatically, this tells you you cannot include a fixed cost in the calculation of cost of sales. So therefore, we are going to jump the fixed manufacturing overhead. We don't worry about that, but we want the variable overheads. Right, let's deal with the variable overheads. Right, our variable overheads, it's a figure of 5355. Right, this was incurred for 15,300 units. What about for 20,000? So 5355,000 divided by 15.3, I get cost per unit multiplied by 20,000. Then I can get a figure of 7,000 units. Right, so I've left out the fixed manufacturing overhead costs because I'm using variable costing. Right, add everything from opening inventory. Let's see what we have. Right, you are going to get 140,000. So this is total available for sale. Right, then you say less your closing inventory. Right, so you can see right up to closing inventory, when we are using the variable costing, we don't include the fixed manufacturing overhead cost. Anything that is not included up to the calculation of gross profit, it is a periodic cost. So we are treating the fixed manufacturing overhead cost as a periodic cost. Now, the first thing that I need with closing inventory, I need to determine the number of units in closing inventory. So for that, you will take your opening inventory for a period. Right, you will add your production units, right, quantity produced, right, then you get a quantity. So let's see what we have. We know we started with 600 units. Then we produced 20,000 units. Then we have 26,000 units. So this is available for sale. Right, then we say, how many units did we sell? So less sales units. We have already calculated the sales units. We said 16.5. Right, which is what we calculated here. We said the number of units sold, 16.5. Right, so from a possible quantity of 26,000, if we sell 16,500, we are then left with 9.5 units. So therefore, in our closing inventory, is that correct? No, that's not correct. That's not correct. Right, this is not 26,000. That's 20,600. So therefore, we have 20,000 minus, 2,600 minus 16,500. We are sitting on 4.1 units. So these are closing inventory units. Right, so that's the first thing that you need. And then now you need to find out the cost per unit of inventory. Now, before you can answer that, you need to check the inventory valuation method that is in use for this particular calculation. Now, they were very clear. We are using the FIFO method, right? What does the FIFO method mean in this instance, good people? Right, we know it stands for first in, first out. But in your calculation of closing inventory, right, what does it tell you when they say you are applying the FIFO method? Right, never fall behind in CTA, never fall behind in CT1. You will have serious problems. Right, we discussed this one of fixed of FIFO and weighted average cost. So by now it should be on your fingertips. Right, remember this is first in, first out. Let's analyze. We started the year with 600 units in opening inventory. Right, but then we sold a 16.5. So we are saying of that 16.5 that we sold, we started by disposing the 600 that was in opening inventory because that was what is our first in. So what it means when I now deal with closing inventory, with the 4.1 units that I have in closing inventory, these units don't contain any residual of the units that we're having in opening inventory. The opening inventory has been completely sold. So in our calculation of closing inventory, we cannot be affected by the cost of opening inventory. So therefore, our cost per unit based on the FIFO method should be based on the cost per unit for the current year. We shouldn't include any cost of opening inventory. Then we can say, what is the cost per unit for the current year? The cost per unit for the current year, right, will be made up of these particular costs. So you need to add these, get the total, and then divide by 20,000 units. So therefore, we are saying our cost per unit here, we have, I think it's what, 25,000, right, plus 9 million, not thousand, plus 7,000. Right, this is going to give us a figure. Right, let's verify. Yeah, that's 25,000. So we have left out the opening inventory there. So we say 25 million plus 9 million plus 7,000. Now, this 41 million represents the total cost of production for the current year based on direct costing. Then we are saying this 41 million was incurred for the production of 20,000 units. So what was the cost per unit? That's what we are looking for. Right, so that will have been 2,550. Right, you can also calculate that by simply taking your total cost here. So which normally, because sometimes you may have plenty of things here, you may have direct material, plastic, direct material, metal, direct material, this and that. So you may have a longer calculation. You don't want to be wasting time adding these things one by one, like what we've done. Right, remember you have already compiled a total here. You take the total, which is 4,140. But that total contains your opening inventory, which is 1140. So just remove the opening inventory from that total. Right? And then you simply divide that by 20,000. Right? And then you will get your 2050. Right, so we have the number of units in closing inventory, which is 4.1. We have the cost, which is 2050. So we can determine our total of the closing inventory. So 2050 by 4100, that is going to give me a figure of 8405,000. Right, then we calculate going downwards. Right, so we are going to get a figure here of 33, right, 735,000. Right, we don't normally have a name for that. And then we add any other variable cost that we have. Any questions, good people, up to where we are? Right,
No.
here on everything. Right, then we look for any other variable cost that may be there. Right, so if we check here, we can see that we have variable selling costs. The figure is for,
Hello. Hello.
yes, sir.
Yes. Can you please repeat the FIFO method, the one that you have already done?
All right.
Uh,
So
I didn't understand.
sure. So what is important with the FIFO method is to understand what it entails. First in, first out. So here, when we sell from our stock, we start with the stock that was there first. So obviously, when we started the year, we already had this opening inventory. There are 600 units there. Right, then we sold 16.5 in total for the year. It means we first disposed the what? The 600 units before touching the 20,000 that we produced in the current year. So what it simply means is that when we look at the 4.1 closing inventory units here, right, we are saying it does not contain any traces of opening inventory based on the assumption that we made of first in, first out. So therefore, the calculation of closing inventory must not be affected by what? By the opening inventory. That is why when we are now wanting to calculate to say what is the cost per each unit in closing inventory, we use the current production cost, leaving out the what? The opening inventory. So we did our calculation, we then saw that we have got 4.1 units in opening inventory. But then we say now, what is the current cost of production per each unit produced? So leave out the opening inventory, add the direct material, direct labor, variable overhead, get your total current production costs. Right, those were made up of 20,000 units produced. So therefore, you will get your 2050 is the cost. Right, so that is how we calculate the what? The closing inventory. Maybe to understand it even better, you need to think about the weighted average cost method. Right, please unmute if you want to contribute. Ne? Thank you. Right, if you had the weighted average method, now based on the weighted average method, right, now if I mute you, then you won't be able to make comments. That's the downside, but we have no choice. We need to make sure that we are hearing each other. Sorry about that. I muted the wrong person. Sorry. Right, so if we are using the weighted average method, now remember, based on the weighted average method, we are saying we cannot assume first in, first out. So what we'll be saying is that our inventory got mixed up in the store. So therefore, first in, first out cannot be our assumption. So if the inventory got mixed up, we are saying at the end of the period, when we have our closing inventory, there is a possibility that we may still have some traces of opening inventory. So when calculating now the closing inventory value, we cannot ignore the opening inventory because some units in closing inventory may be opening inventory. So with that in mind, now what you do is you now take all these costs here, which we have already calculated. We got 41, 42, 140 there. Right, so if we were using weighted average cost method, we're going to say 42, right? I think it's 42, 140 there. So this will be the total cost, but you must remember this is made up of opening inventory plus current production. So if I now want to know the cost per unit on average, I have to divide by 20,600 there, which is the total cost that would have given me that particular cost. So in this instance, I will have 245.63. So this will be my cost per unit based on the weighted average. Then I'll multiply that by 4.1. So you can see the difference here. Weighted average method says in closing inventory, we may still have traces of opening inventory. We can't ignore the opening inventory. So we incorporate it in the calculation. But when we base on the FIFO method, we are saying there are no traces of opening inventory in closing inventory. So therefore, we cannot use the cost of opening inventory to determine the closing inventory. So we simply ignore the opening inventory. Right? Any questions on that, good people? Are we clear? Are we sorted today? Right? Hopefully, we are on the same page. Hopefully, we are on the same page. Right, once we have our closing inventory, we then have our variable selling cost here. We are going to add it. Right, so here we're told the cost, the budgeted cost per unit is the same as the actual. So we need to find the budgeted cost per unit. So we say 450,000. Right, but remember we had only sold 15,000. This time we're selling 16.5 units. Now the variable selling cost should be determined by number of units sold. Then these here are production costs. They must be determined by the number of units produced. So 450,000 divided by 15,000, the answer multiplied by 16.5, right? We are going to get 495,000 here. Right, then we can now determine our cost of sales. Right, so that figure, 495 plus 33,735,000. Right, then we are going to have a figure of 34. Right, 230,000. That deducted from the 825,000,000. Right, then we are going to have, right, a figure of 48,270,000. And what do we call that, good people? Right, what do we call that particular costs?
Contribution.
Right, that's our contribution, and also be reminded contribution is marginal income. Right, so this is also known as marginal income. Now, when we have this, then we can say less fixed costs or periodic costs. A periodic cost is any cost that is written off after the gross profit or after the contribution. It does not affect the calculation of cost of sales. It does not affect the calculation of what? Of inventory. That's a periodic costs. So the first one that we are going to have here is actual, right, fixed manufacturing overheads. Right, so the actual fixed manufacturing overhead cost was given here. Right, when they say the actual fixed overhead for January, 33 million. Right, so we have 33 million. Right, what other cost do we have that is non-manufacturing? We have the fixed administrative costs. Right, we have been given, of course, the budgeted figure, right, which is 263. But is it the same as the actual? Sometimes they will tell you it's changed. Here they said all the other costs are the same. So we take it as it is, no changes. But watch out, in another question, they may give you maybe an escalated cost or a reduced cost. Right, so with that, you will be done with this question. Right, so you have your 33,263,000, right? And then 48,270,000 minus the 33,263,000. We are going to sit on a value of 15,007,000, and that's our net profit. Right, so this will be your calculation, and please note that when you do your calculation based on the variable costing method, you don't have to worry about over and under applied overhead. We worry about over and under applied overhead when we are doing the absorption costing, and specifically when we are doing the actual statement of profit and loss based on the absorption costing. Right, if you go back to the question that we did, when we're calculating based on absorption costing, we did not worry about over and under applied overhead. Right, so this is because we're doing the budgeted statement here. So please be clear about this. Most students have a challenge not here. Right, so when you do absorption costing, if it is budgeted absorption costing, you just use the budgeted fixed overhead costs. So here you see we just said fixed overhead, fixed manufacturing overhead. So this would have been your budgeted cost. Right, but when you do the actual statement, you don't use the budgeted fixed manufacturing overhead cost. You use what is called the applied or the absorbed overhead when you are doing the actual statement. And then because of that, you will then have over and under applied overhead to deal with. Are we clear, good people? So first thing that I'm saying, if you are doing the variable costing system, don't worry about absorbed overhead and the over and under absorbed overhead. As long as you are doing what? Variable costing. When you go to the absorption costing, if you are doing the budget, don't worry about it either. But when you do the actual statement, you will have to deal with absorbed overhead and over and under applied overhead. Let's see how that works out. Right, so we are done with the variable costing method. Let's go to the number 2, absorption costing. Right, same information, but this time we're using the absorption costing. Right, we are still applying the FIFO method for inventory valuation. Right, so we still have our sales. The sales figure does not change, regardless of method. It remains the same. So I've got 82500 today. Right, then our changes are going to start here. Here we say less cost of sales. We don't say variable cost of sales. Right, so this is simple because we are going to include also the fixed cost in this calculation here that we are going to do. Right, then we say opening inventory, direct material, direct labor, variable manufacturing overhead, but we include now the fixed manufacturing overhead costs. Right here, we don't have to adjust anything. Right, because the budget was based on absorption costing, the figures have not changed, and the actual is based on absorption costing, so therefore we can utilize the 2.4. In the previous, we were eliminating the fixed manufacturing overhead cost because we were using a different method altogether. So here we use the 2.4. Right, this will not change. We still have 25 million. This will not change. We still have 9 million. Right, this will not change. We still have 7,000. Right, the only thing that we're adding now is the fixed manufacturing overhead cost. Right, now what we do, let me write properly here. Let me say absorbed, right, or applied, right, fixed manufacturing overhead costs. So we don't use the budgeted, but we use the absorbed or applied. It means the same thing. Right, so what we do, we have already done the calculation of the ORR. We found that it was 2.1 thousand rand. This is per unit. So we already calculated that here in terms of the ORR. We determined the 2.1. So when you calculate the applied overhead, this is what you do. Right, you say actual units multiplied by the ORR. Now what is happening is very simple. We are trying to mirror what happens in the actual world. Now remember, for the fixed manufacturing overhead cost, we had to determine a projected cost per unit, which is the ORR. It's a budgeted cost. So that any unit that we produce during the year, we are going to charging the fixed manufacturing overhead cost based on the ORR, which is a budget. So before the end of the year, the fixed manufacturing overheads that will be sitting in our system will be based on the ORR, which is cost per unit, multiplied by the number of units that we would have produced during the year. Because every unit that you produce, you charge a fixed manufacturing overhead cost for it, which is based on the ORR, because you don't have the correct actual figures until the end of the year. So you have your 2.1 here. Then you will say how many units were produced. We know that 20,000 units were produced. So we say 20 by 2100. We are going to get a figure of 42,000. So we are saying before the end of the year, in our system, we will be sitting on 42 million in terms of the fixed manufacturing overhead costs. What we'll then do at the end of the year, once we have the correct figures of the actual cost that was incurred during the year, we will then adjust our figures. But that adjustment is done after calculating the value of inventory. Any questions on that, good people? Are we clear? Right, are we there?
All clear.
Wonderful. So how much are we having? So this time we have 85. right? We are sitting on 85. Right, 400,000. Right, then we say less our closing inventory. Right, we are using the FIFO. We know the style. We take the 85,400, but it includes opening inventory. So we remove the opening inventory there. Right, then we divide that by 20,000 units. Right, then we multiply that by the number of units in closing inventory. So the number of units in closing inventory does not change. It remains the same. Right, but because we've got a different figure here after including the fixed overhead, right? So we need to recalculate the cost per unit by simply saying the total, which is 8.5. If I'm using FIFO, I don't want this cost here. I remove it. Then I'm left with the current production cost divided by 20, multiplied by that. So that's my calculation there. Any question there?
What is the 4.1 figure?
Sorry, come again.
The 4.1 figure, I get it's 8,500 minus 2,400 divided by 20 multiplied by 4,100.
Yes. Or this figure is the number of units remaining in closing inventory. So this calculation that you have here will give you the cost per unit, né? Cost for 1 unit. Then how many units do we have in closing inventory? 4.1. Where did we get that figure? We already calculated this one, né? So it doesn't change.
Okay, thank you.
Sharp, sharp. Right, so once we have that closing inventory as per the norm, we deduct that. And when we are using the absorption costing, remember this is financial accounting. Immediately after deducting your closing inventory, you immediately have cost of sales. You know this from financial accounting. Right, so that we then say that from 85400,000, that is going to give me a figure of 68,385,000. That from 82,500,000, that is going to leave me with 14,115,000. So this that we have is our unadjusted gross profit. Right, usually you see most UNISA memos don't include a name there. They just leave it blank. So you can leave it blank, but it's unadjusted gross profit. Right, what we then do, we need to now check whether there was an over application of the overhead or not. What are we talking about? This overhead here that we included there, it is based on estimate figures. So it's an estimate figure that we have. But at the end of the year, now we are able to add our invoices for the fixed overheads and determine the actual overhead cost. Either we overcharged ourselves or we undercharged. To find that out, you do a calculation like this. So here we are looking for the over or under applied overhead. Right, in which case now you will say, right, you will take your actual overhead minus the applied overhead. Right, so your applied overhead is the 42 that you charged yourself based on your what? Projections. Then for the actual, you don't calculate that, they will give you in the question. Right, so they said the actual fixed overhead for January was 33 million. So therefore, we are saying our 33 million minus the 42. So this is our 33 million. Right, minus the 42 there that we are having. So that therefore we then have 33 million minus 42, that would be 9. Eh? That will give us 9 million. So what are we saying? We charged this, but the actual cost did not actually add up to 42. The actual cost is 33. So therefore, this is over-applied. We over-applied the overhead. We charged ourselves too much. So therefore, we are saying if you overcharge yourself on an expense, you reduced the gross profit. But now that we've got the correct figures, we can correct gross profit by adding back this 9,000. So therefore, we come here, we say add over applied overhead. So we add the 9 million. Right, then we can get the final gross profit figure here. So what you get here will be the gross profit. So if you say that 14,115,000 plus the 9 million, you are going to sit on a figure of 23, right? 115,000, and that's your gross profit. Right, any questions on that, good people? If it is under applied, it means your gross profit. Well, let's see here, what did we do? Right, we had deducted that. Remember, this reduces, it increases cost of sales, therefore reduces gross profit. So we have to add back the 9. So this is over applied. If it is under applied, we would have charged ourselves very little. So our gross profit will be overstated. We will need to reduce it. And then you say less periodic costs. Right, then you say less periodic costs. In which case you have the sales, which is variable. You have the admin, which is fixed. So the admin was 263,000. The calculation does not change. So here we did, the admin was 263, which we already dealt with. And then we also got 495 in variable selling cost from
Hello,
the
sir.
machine.
Sorry.
Yes, sir.
Hello.
Yes, sir.
Yes, I just want to ask. I just want to ask if it was under.
Right. If it was under, you were going to deduct. Right, because if it was under, it means you undercharged on the fixed manufacturing cost, which means your gross profit is overstated. So therefore, the difference must be deducted. Ne?
Oh, okay.
Right, so that area there, students normally make mistakes on that. You need to make sure that you are very clear on whether you are adding or you are deducting. Please take your time there and make sure you master that. Right, so that therefore here I'm sitting on 22,357,000 in terms of my net profit. Right, so this will be your calculation based on absorption costing. So you will note that this calculation that we did today is slightly different from the work that we did last week, right? Especially in the area of this year, we used the absorbed or applied. And also because of that, we then have what we call over and under applied overhead. We did not have that in the previous question. This is because the previous question, even though similar, we were dealing with the budgeted income statement. So if you are dealing with the budgeted income statement, you don't have the actual. But when you deal with the actual, you have the budget, which means you can compile the applied, and you have the actual, which you need to compare. So that is why there is a difference here. Any questions on what we have on the board, good people? Are we understanding it? Right, and then there are two ways of dealing with this, of calculating that figure. Okay. Right. So let me copy this. I want to show you another way of dealing with this. Right. So I just want to show you another way of dealing with this. Okay. So that one I need this thing. Right. So what we need to do here, we need to calculate what are called we need to calculate the fixed overhead variance. Right, we need to calculate the fixed overhead variance, and there are two components to this. Right, there is the fixed overhead expenditure variance. There is the fixed overhead volume variance. Right, so instead of saying over and under applied overhead, you just calculate the variances here. Right, what is a variance, good people? This is standard costing. What is a variance? Right, when we talk about a variance, this is basically a difference between, right, this is difference between actual, right, and expected, which means budgeted performance. Right, so when you have an entity and you are doing your things properly, you compile a budget, right, and then you perform the actual performance. So now at the end of it all, or at regular intervals during the year, you need to make a comparison of the budget and the actual performance so that you can see and identify if you are not adhering to the budget. The budget is your guideline for actual performance. So the variance is when there is a difference between the actual performance and the budgeted performance. That's a variance. Now, the reason for calculating variances is simple to pinpoint where there are differences. It is especially important where you are struggling, where you are not meeting your objectives, because you can pinpoint now where the problem actually occurred. And then you can put the remedial action into effect. Right, so what we need to do here, we need to calculate the fixed manufacturing overhead variances. Right, let's go to the calculation. So we have what is called the fixed manufacturing overhead expenditure variance. This is the easiest variance that you can calculate. So this particular variance, the formula is your actual overhead right minus your budgeted overhead. Right, so you go to the information provided. Your actual fixed manufacturing overhead was given 33 million. So you take it as it is. All right, so we have our figure 33 million. Then we say, what is the budgeted overhead? The budgeted overhead is the one that was given here. Fixed overhead, 32,130,000. That was your budgeted overhead. Remember, these are budgeted results. So 32,130. Right, then we can have our variance. So 33 million are the total actual overheads incurred, but we had budgeted for 32,130,000. Right, so that gives me a difference of 840,000. Now, with a variance, you have got to indicate whether it is favorable or unfavorable. You have got to indicate whether it is favorable or unfavorable. Now, a favorable variance is where actual performance is better than the budget. That's favorable. It means it will improve profitability. Then a negative or an adverse or unfavorable variance is when actual performance did not match up to the budget. It is poor compared to the budget. Now, these are expenses that we're dealing with, right? We had budgeted only 32, but we ended up incurring more. Now, this one is an adverse variance. Right, so this one, when you come here, if it's adverse, right, it will go in as a negative figure. That's an adverse variance. So that's your expenditure variance. Right, so we can see that we incurred more expenditure than expected. So therefore, it will be unfavorable. Then we have what is called a volume variance. Now we have to understand one thing when it comes to fixed manufacturing overhead. Right, remember when you are dealing with a fixed manufacturing overhead cost, let's say it's 10,000. If you produce 10,000 units, then the cost per unit is going to be 1. This is because the fixed manufacturing overhead cost does not respond to changes in output. So if you have 10,000 in fixed overheads and you produce 10,000 units, then the cost becomes 1 rand. Now, if your fixed overhead is still 10,000, but somehow you only produce 9,000, then you are going to have a small problem. Your cost per unit in terms of the fixed overhead cost will increase. Let me put 8 here. Let me put 8. Right, so that we can see clearly what is happening. Well, yeah, let me put 8. Right, so 10,000 divided by 8,000, you are going to have now a cost of 1.5 per unit. All right, so when you have a certain maximum capacity, or when you have got, or when your actual number of units produced, right, is less than the quantity that was budgeted, then you are going to have a problem in terms of the cost per unit. Your cost of productions are going to be high. So it is always preferable that you produce more so that you reduce the cost per unit to its what? Minimum. Are we clear?
Yes.
Right, so you need to calculate a volume variance this time, which captures that. So we are saying, based on the volume variance, we are saying, right, okay, want to calculate the volume variance now. So this is fixed manufacturing overhead volume variance. There are 2 ways in which you can calculate that. Right, the first one, we can then say, what is the budgeted, or what is the, we can say, what is the actual production less the budgeted production. Right, divided by the standard cost, which is the ORR. Right, our actual production was 20,000. Right, hopefully you remember and you know where I'm getting these figures from. The budgeted was 15,300. So we produced more. Right, so this was given here. 15.3 is our budgeted units, but our actual production is what? 20,000. Right, the ORR we calculated as 2.1. Right, so if we calculate that, we say 20,000 minus 15,300 multiplied by 2100, we are going to get a figure of 9870,000. Now, this here is favorable. We are saying that we did better in terms of utilizing our production capacity. Our volume of production, actual production, was more than the budget. And this is going to improve our profit because the absorbed cost per unit in terms of the fixed manufacturing overhead cost will be smaller than budgeted. And therefore, in this instance, we are doing very well. So that's a volume variance. Are we clear? We can still calculate that by saying what is the budgeted fixed manufacturing overhead less the applied or absorbed fixed manufacturing overhead. Right, the budgeted overhead, we already have it there, is 32,130. The applied overhead, we said applied overhead, we did it in our calculation here, we got 42,000. So we say minus 42,000. Right, then we can note the difference here. So 32,130,000 minus 42,000 or 42 million, sorry. Right, that will give us a value of 9870. The applied overhead that we have, right, is more than the budgeted figure, right? So therefore, we know what this is, if it's favorable. Right, if you have it like that, this is going to be a favorable variance. Right, the budgeted figure is less than the applied. The budgeted figure is as good as your actual here. Right, so these are the two methods that you can calculate the fixed manufacturing overhead volume variance. Right, you need to master these two at least for direct and indirect costing for test number 1. If you don't have standard costing, you will deal with standard costing later. So there will be more detailed lessons on standard costing later. But for now, you need to master the fixed manufacturing overhead volume. So now you then have a positive figure of 9870,000 here, which is positive. So you now add the positive and negative, you are going to end up with 9 million, which means you are back to the same figures that you got based on the previous calculation, where you used the over and under applied overhead. All right, so you're going to get your 23,115,000, which is your gross profit. Right, so this is how you can calculate this. Now, this is more prominent with the CTA guys. CTA 1 and 2, this is how you deal with the over and applied overhead. The undergraduate guys, most of your memos, you are applying this. So for CT1, this is what you apply. But CTA, you must know both. You need to know how to calculate the over and under applied, because it can come as a separate standalone calculation. Though in your module, you'll be expected to compile like this. Then the CTA one, you compile like that. Any questions, good people from the floor? Are we clear?
Yes, sir.
Right, then the final thing that we need to do on this particular question, right, we need to do a reconciliation. Right, reconciliation of the net profits. Right, with the reconciliation, we are simply saying there is only but one major difference between the two calculations, which is the treatment of the fixed manufacturing overhead costs. In one of the calculations, which is absorption costing, the fixed manufacturing overhead cost is included in opening and closing inventory. Then in the other calculation, which is the direct method, the fixed manufacturing overhead cost is not included in the opening and closing inventory. So we are saying if we know what makes up differences between two figures, we can then work out those differences and adjust them on one profit figure and arrive at the other profit figure. So assuming that we start with net profit, right, based on absorption, right, costing here, right, which is that figure that we got there, right? Our overall figure was 22, right, 357. So what we want to do, we want to work from this figure and arrive at the net profit based on what? On variable costing. So we are going to say differences in opening inventory. Right, the opening inventory based on absorption costing is always more. It includes the fixed cost, which is 2.4 there. That's opening inventory. But the opening inventory based on variable costing was less because it does not include opening inventory, and the figure is 1140. So we then say 1140,000. Right, then we have our difference. So it's going to be that 1260 that we calculated before. Just to verify it. Right, so we are then saying you need to examine the impact of this on the net profits. Right, opening inventory by nature increases the cost of sales. And by increasing the cost of sales, it reduces net profit. So we are saying we added a 1260 more in absorption costing than what we did in variable costing, thereby reducing our net profit in absorption costing by 1260 compared to variable costing. So therefore, if we want to get the same figure as in what? Variable costing, we need to add this figure here. So we add. Any question on that, people? Are we understanding it? Right, are we sure we got that one?
No.
Right, Angithi, we have started our calculation with the net profit based on absorption costing. And our aim is to end up with the net profit based on variable costing. And the difference between these two statements is in how we have treated the what? The fixed
Okay.
manufacturing overhead cost.
Oh, so we not started in closing was the same, G. 42.
Sorry. Please come again. All right, I think that was on the side. Right, so we are saying that the difference is these two methods, they differ in how we calculate the opening and closing inventory. So if you go to the variable costing, right, our opening inventory amount here was only 1140. This is the figure. Now, this is because we had removed what? The fixed manufacturing overhead cost there. But when we go to absorption costing, our opening inventory is more, right? Because here it is inclusive of the fixed manufacturing overhead cost. Are we clear on that first?
Yes.
Right. So the question is, what is the impact of this on the two profit figures? Right. We have to understand that a opening inventory is added to a production cost for the year in arriving at cost of sales. So opening inventory by nature increases a cost, which is cost of sales. And we are saying included in the net profit based on absorption costing was an additional amount, right, of 1260, which is the difference here between the opening inventory values, which was not included in a variable costing. And this amount, because it is what opening inventory, it was reducing profit. So to align with the variable costing, add it back. That's what we are doing. Are we on the same page?
Yes.
Right, let's go to closing inventory. Right, again, if we go to closing inventory, yes, ma'am. Right, is there a question? Right, let's go to the closing inventory. Again, the closing inventory for absorption costing is more. This is because we are including the fixed manufacturing overhead cost here. So we now have 17,050 there, or 17,1. Let's see, what was the figure? It's 17,015, like this, 000. So that's the closing inventory based on absorption costing. Then we say, what is the opening inventory based on variable costing? It will be less. Oh, sorry, what is the closing inventory based on what variable costing? It will be less. 8405. Because we are not including absorption costing. So therefore, we say minus 8405. How much are we going to have?
It's 861.
Right, so we have 8261, 000. Right, the question is, what is the impact of this difference? You have to understand the impact of closing inventory on cost of sales. When calculating cost of sales, we say less closing inventory, which means it reduces cost of sales. Cost of sales is an expense. When you reduce an expense, you increase profit. So our profit here has been increased by 8261 compared with that of variable costing. So if I'm trying to work out the figure of variable costing, I need to less that figure there. Right, if my calculations are all correct, there was no mathematical error somewhere, right, this should give me the correct figure. Am I going to get it? Let's see. 22,357, 000, 1263.
Sorry, sir.
The 27 one is not
On a
correct.
closing,
It's 861.
it's 8,610,000.
Yes.
On the closing event, the difference.
Yes, difference.
Right, so we're saying this changes. Let's see.
It's 8,610,000.
Right, 8,610,000 there. All right. So we are saying 22,357, 000, plus 1268, 000, minus 8610, 000. Right, we are going to get 15,007.
15007.
Right, so this is net profit based on variable costing. So that figure should tie back to our profit figure here. If it doesn't tie back, something is wrong. Right, so we are happy 100% on everything if it ties back to that. So this is what the reconciliation is all about. Right, I must say it's very popular to get that reconciliation. Even if you don't get the reconciliation, they may just say to you, calculate your income statement based on absorption costing. And then they can just say to you, what is the net profit based on what? Variable costing. So they won't be asking for the statement. They want this particular calculation to determine this value. And I must add, most students don't get this one right. The reconciliation, they vice versa there on what is to be added and what is to be deducted. So I'm mentioning it so that when you are going through the recording, you make an effort to make sure that you give this attention. It's very popular. You will probably lose 4 marks here and 5 marks here in an exam if you are not clear here. Right, so that was the question. Any questions, good people, from the floor on this one? Right, you need to start with a question like this and you master it. Once you master it, of course, in the exam, at this level, you won't get easy exams. So your information usually is not provided easy like this. It's impossible. In the exam, there will be a very big case study, and a number of topics will be mixed in that case study. So information won't be readily available like here, where you know that everything is just on half a page and you have everything. But if you master like this, you won't have a problem with those long case studies, because what you'll be doing, you'll be applying exactly the way that we've applied here, except that the question itself will be complicated. So I want us to look at a slightly complicated example than this to have a good feel of what a question in an assessment may look like. Right, so I've got another question that I shared with you, right, which I want us to look at. It's called delicious cereals. Just look at the question that I gave you. It's written question 4. Right, so you can see this one now looks complicated because there's a long story here. See, right, this is because when you go to the requirement, they are asking you about direct and indirect costing, standard costing, APC costing. In between there is also some pricing. Right, so this is how a typical question should look, but you'll see it doesn't change a thing. You are still going to apply exactly how we did the previous question, maybe with more details instead. Right, in the requirement here, number 1, they say determine the total budgeted contribution per unit or per product type by preparing the budgeted marginal costing statement of delicious cereals for the year ended 31 March of the year 2016 in as much detail as possible. The total column is not required. Round all your workings to the nearest rand, 18 marks. So what is happening this time? We've got 2 products being produced. So they want a marginal costing statement per each product type. But this time they said, don't worry about the total. In another question, they may say total required. Right, so that's what we want to do, just to practice further and make sure that we are clear on this topic. So we want a marginal costing statement. Right, so this is variable costing statement. Right, which month is it? Month or for the year? For the year ended 31 March 2016. Right, so for the year ended, right, 31 March of the year 2016. Right, remember with this, you must always double check. Are you doing the actual? Are you doing the budgeted? So that you give them exactly what they are looking for. It is sometimes possible to do both with the information that you'll be having. So make sure to double check that before you proceed and start working on the question. All right, so let's check the question, the required here. All right, so here they wanted they wanted the budgeted contribution per product type. So instead of saying marginal costing statement, we should have said budgeted contribution per product type. But anyway, it's fine. So we are dealing with the budget, not the actual. Right, let's go to the case study. What does it say? Right, Delicious Cereal Private Limited, DC, is a medium-sized company that produces and sells 2 types of cereal. The corn cereal that they call the CC and the whole wheat, which is the WC, to major retailers. So we have identified our 2 products, right? There is the corn cereal, right? And then there is the wheat cereal. How do you spell that? Is it like this? Right, let me check. Corn cereal. Right, there is an A somewhere there. right, like that. So these are the two products that we have. Right, so as usual, we know that an income statement will always start with
Sales.
sales. So we need our sales, and then we say less variable costs. Right, remember here they just want contribution, so I can just say variable costs. If you want, can say variable cost of sales, yeah, fine. Right, so let's go to the question. Let's see what we have. And then they say, right, each of the two types of cereal are sold to retailers in units of 1 kg per box. The company operates from the Centurion area, Pretoria, with most of its clients situated in and around Gauteng. Right, DC makes use of an absorption costing system, and all its inventory items are valued using the first in, first out. So they are actually using absorption costing. So we will be working from the information provided, which is based on absorption, and adapting it to variable costing. Right, then they say the following extracts are from the budgeted and actual results for the year ended 31 March of the year 2016. Right, so we have the actual information, we have the budget. Tina, we want specifically for the budget. Right, in terms of sales, you must refer to note number 1. Right, the budgeted annual sales volume were 100,000 and 50,000 for the CC and WC respectively. Then the annual or the actual annual sales volume were the same as the budgeted annual sales volume for both products. Selling prices were budgeted at 30 per unit for the CC and 35 per unit for the WC. So we have been given the budgeted sales quantities and the budgeted sales price. So we have 100,000 multiplied
Times
by 30. Right, and then we have how much? 50,000
50,000.
by the 35.
35.
So those are free marks. So this will be 3 million.
1,750,000.
1,750,000 will be the
Yeah.
sales price for the whole wheat.
Yeah.
Right, then from there we then go to opening inventory. Right, on the opening inventory, we should be very clear that the figures provided, because we are using the absorption costing method, they should be adjusted to suit what? Variable costing. Right, the opening inventory was given on 1 April, the budgeted figure is 37,800. It is the same as the actual. Remember, when you do your budget, you already have the closing inventory with its cost from the previous. The closing inventory then is your opening inventory. So you budget based on that, and also the actual will be based on that for the opening inventory only. Right, so we can see there is 37,800 there. Then we are referred to note number 2. Opening inventory on 1 April consisted of 1,000 units of CC and 500 units of WC, budgeted at 24,600 and 13,200 respectively. The fixed manufacturing overheads were absorbed at 1.2 per unit in 2015 financial year. For the year ended 31 March of the year 2016, the company had no opening or closing inventory of any type and work in progress. Right, so we need to calculate the values of opening inventory per product type. Right, what should we do in light of the fact that the figures given are absorption costing, but we want variable costing? Right, we've already been given the figures broken down per each product type. So for there were 1,000 units for the CC and 500 for the WC, giving us a total cost for each of 24,600 and 13,200. Right, and then the other one, that's 13,200. Now, these are based on absorption costing, which means the figures that we have in terms of opening inventory, they include the fixed manufacturing overhead cost. We need to eliminate that. We need to find out the ORR. The ORR is the absorption rate, so which is the absorbed overhead in the previous year. But this time it was given, where they say the fixed manufacturing overheads were absorbed at 1.2 per unit. So we don't have to calculate ORR, it's given. You are told that each unit consisted of fixed manufacturing overhead costs of 1.2. So that's easy. So I just come here, I say minus 1.2 multiplied by 1,000 units here. The ORR does not give a different figure per product type. It is always the same. So therefore 1.2 multiplied by 500, then we deduct these figures. So 1.2 by 1,000 from 24,600, that will leave us with 23,400. This is the figure that we use here, right? Which is comprised of only variable costs of the prior year. 1.2 by 500 from 13.2, that gives me 12,600. So then we have 12,600. Right, so you can see we are doing exactly and applying the same thing that we're dealing with, except that this time the information is much more broader than what we had today. There is a story, not just figures. Right, any questions, good people, on what we have so far? Right, so next we want to look at the manufacturing costs. What makes up manufacturing cost, good people, in an absorption costing system? If we are saying manufacturing costs based on absorption costing system, we will expect the variable manufacturing cost, which is direct labor, direct material, variable manufacturing cost, plus the fixed cost.
You fix the cost.
So it includes the fixed cost, but I want only the variable manufacturing cost for the purpose of compiling what? Contribution.
Okay.
We are referenced to number 3. Right, where they say the company had budgeted to produce 101cc and 51,000 WC units during the 2016 financial year. These budgeted figures or units are equivalent to the company's annual production capacity. However, the actual annual units were 100, 500,000 and 50,300 for the WC. I'm interested in the number of units that we actually produced. Right, then there is additional information now concerning note number 3. We'll come to number 4 later. Right, where they say the primary ingredient of CC is corn and for WC is wheat. Then they continue and say, right, both the CC and the WC use the same ingredients, which is barley, sugar, and vitamins. The combined budgeted cost of the secondary ingredients per unit and is 7 rand per unit, and the combined actual cost of the secondary ingredients per unit is 60. Right, it's just that we have more detail than in the previous question. In the previous question, you were given direct material and you were given the direct material already per unit. Right, if there were 5 raw materials that were being used, you were not given a breakdown. They were already combined into a total. Now, in this question, you are now given per unit. So these are ingredients that are being used to provide to manufacture the corn cereal and the whole wheat. So now these are direct materials, but you have been given them separated. So you have to show them separated. So therefore you say secondary ingredients. Right, so these secondary ingredients, that's direct material. That's your direct material. If you want to be expressive, you can also just say direct material. Right, and then you can say secondary ingredients. Right, either way, You are still correct. And then we calculate these on the side. Right. So if we go to the site, how many units did we plan to produce of each product? Right. For the CC, we plan to produce 101. For the WC, our budget was to produce 51. So therefore, we say 101,000, and then we say 51,000. Now remember, the budgeted cost per unit is 7 here. So that will give us 707,000, and then 51,000 by 7, that gives you 357. So there is nothing difficult, just that we are showing each ingredient on its own. So we have 101,000 here. Right, there will obviously be more raw materials. Right, let's continue. Right, the actual corn costs per kg for the 2016 financial year was 7.8, but the budgeted cost per kg of corn was 8. Each unit of CC requires 0.5 kgs of corn. Both the budgeted and the actual corn usage per unit were the same for the 2016 financial year. Right, then we have primary ingredients. We have corn. Right, so for the corn, right, we have 101,000 units that we want to produce. Each unit is going to require, according to the budget, 0.5 kgs. So when we multiply 0.5, which is the consumption per unit, by the number of units produced, we get the total kgs that we require, and then we multiply that by the budgeted cost per kg. So multiplied by 8. So therefore, 101,000 by 0.5 by 8, then we get 404. Now corn is only used for the corn product. And then these guys, the wheat or the WC uses what? Wheat, not corn. So now we then go to the wheat. This is what they've said. Similar calculation. The wheat used in WC is bought in kilograms. The budgeted cost per kg was 15.34. Right, each unit of WC requires 0.5 kgs of wheat. The actual cost per kg was 15. The actual usage was 0.6. I'm worried about the budget. So therefore, the budgeted consumption is 0.5. Multiplied by the budgeted cost per unit, which is 15.34. So this would have been our budgeted cost per unit. So the budgeted cost per kg, not per unit, 15.34. So we just say 51,000 times 0.5 times 15.34. Right, then we are going to get a figure of 391,170. Right, are we following, good people? Are we on the same page?
Yes.
Right, so it's just more things to deal with, but the style is the same. Now, both CC and WC are sold in the same sized, customized boxes made from the soft cardboard. The budgeted cost of a customized box was 3 per unit. The actual cost is that. Right, so this one we are looking at packaging. Right, we have 101,000 units. What is the cost for each?
3.
Is 3 rand. So multiplied by 3. And then here we've got 51,000 also multiplied by 3.
153.
So that would be 303 here in terms of the packaging. And then the 51 by 3, that gives you 153. So that represents our packaging. So all these are variable manufacturing costs. Right, what about the labor? Right, the budgeted direct labor rate was 50 rand per unit or per hour, sorry. Then the budgeted direct labor time to produce each unit is 15 for the CC and 10 minutes for the WC. Right, production employees can work interchangeable between the two products. The actual direct labor minutes per unit were equivalent to the budgeted direct labor minutes per unit for each of the two products. The actual direct labor rate was 15% higher than the budgeted and the direct labor rate per hour. So I'm interested in the budgeted information. So we say direct labor, right? We are told that for the cone, the number of hours required or minutes, it is 12 minutes. So what we do, we take the 12 minutes, convert them into hours by dividing by 60, and then multiplying by 101, right? And then multiplying by the cost per hour, which is 50 rand.
50 rand.
Right, then we can have that. For the other one, it would be, they said 10 minutes, ne? It will require 10 minutes for the WC. Right, so we do a similar calculation, 10 divided by 60, multiplied by 51,000, multiplied by 50 rand. So this is the calculation that we will have. So 12 divided by 60, we get the number of hours required to produce one, multiplied by 101, 1,000 units produced, multiplied by the cost per hour, we get 1,010,000. 10 divided by 60, we get cost per watt per hour by 51,000. By 50, we are going to get 425,000.
425,000.
The figure that we got, that's direct labor. Right, and then next, what do we have? Right, so then we have the budgeted and actual variable manufacturing overhead. Right, so we do add that variable manufacturing overhead. Right, what does the question say? Right, these are given per unit. These are variable, but the variable manufacturing overheads per unit is 2 rand for both products. So that's easy. We are producing according to the budget 101 51
times 2 rand.
Yes, thank you. And we get 202, and we get 102 there.
102.
Right, and then we are done with the manufacturing overhead. Remember, we don't include the what? The fixed manufacturing.
Fixed.
Right, so we are opening inventory. Any question?
Why you don't have sales?
Sorry, come again, ma'am. Right, I'm adding there. Let's see how much we are having. Right, so we then have, right, 2043,400. Right, and then the other one, 12,600 plus 357,000 plus 391,170 plus 153,000 plus 425,000 plus 102,000. If everything is correct, I should be sitting on 1440. Right, 770. Then we say less closing inventory. Right, let's look at the closing inventory units. Right, as usual, we say opening inventory. Right, for the CC and for the WC, we're told 1,000 here, we're told 500 there. Then we say production units. We budgeted 101,000. We budgeted 51,000. Right, so which means here we are sitting on 51,500. Right, here we are sitting on 102,000. And then we say less what was sold. Right, in terms of sales units, what did we say? Right, so we sold how much?
100,000.
Right, so we sold 100,000 here, which means we are sitting on 2,000. And here, 50,000.
50,000.
All right, so which means we are sitting on 1.5 units. Right, how do we calculate the value of closing inventory? We have got to check the method. Are we using FIFO? Are we using weighted average cost? Right, we are using the FIFO method. When we use the FIFO method, we are going to ignore the opening inventory. So if I don't want to waste time and start adding all these things one by one, I will take the total figure, which is 2043,400 today. Right, then I will remove the opening inventory, which is how much? 23,400. So I've got current production cost, and then I'll say, how many units did I produce? 101. Right, then the answer that I get from the bracket is cost per unit. But in stock, I'm only remaining with what? 2,000 units. I have my closing inventory. Any question on that? Right, so how much am I going to have? 2043,400 minus 23,400 divided by 101,000 times 2,000. Right, I'm having 40,000. Are you having that? Right, is it correct? Let's see. Right, 23,400 plus 101,000 plus 404,000 plus 303,000 plus 1010 plus 202,000. I'm getting the same. Minus 23,400, the answer that I get divided by the number of units of production 101. Right, multiplied by the 2,000 units remaining, I'm getting 40. So therefore 40,000 is what we deduct here. From the 2043,400, then I am going to have, right, a figure of 200,3,400. Right, are we clear on the calculation of that opening inventory? Opening inventory, closing inventory calculation is usually a challenge for students. Hopefully we are clear. Right, then we deduct the opening inventory amount, which is 12.6. Right, then we divide this by the number of units produced. Remember, when I solve this bracket, I then remain with current production cost divided by the number of units produced. When I solve this bracket, I remain with cost per unit multiplied by the 1.5 left at the end of the period. Right, so I'm going to have 42005. This is the figure that I'm going to have there. So 1440770 minus 42005. Then you will have that. When you are practicing your closing inventory, always make sure that you are also able to calculate based on the weighted average cost, so that if they give you that, you don't have the challenge. Right, then we need to add other variable costs. Let's check the question. Were there any other variable costs here? Number 4, this is what they said. The total budgeted selling and admin cost consists of 70% fixed cost and 30% variable cost. The fixed costs are allocated at a ratio of 5:3 between the CC and WC. The budgeted variable cost per unit is 0.2. So this is variable selling and admin. This is dependent on the number of units sold. We sold how many units, by the way? 150,000. Anything that says variable selling costs, you must multiply that by the number of units sold, not produced. Right, let me verify my figure. Is it really 0.2? That's 0.2. Right, 100,000, that would be 20,000. And that would be how much? 50 by 0.2. That is 10,000. We are adding that. Is there any other variable costs? What did they say? There's something that we left here. All right, this is what we had left behind. We have read that now. Right, and then the budgeted annual fixed monthly. Okay, this is for fixed cost. All right, so with that, you'll be done with this question because they simply wanted you to calculate contribution and end there. Right, 2003,400 plus 20,000. We are going to sit on 2023,400. Right, from the 3 million, we are going to be left with 976,600. That is contribution. 1,398,765 plus 10,000. We are going to have 1,408,765. From the 1,750,000, you are going to have 341,235. And that's what they wanted. They wanted us to calculate up to contribution. So with that, you will be done with that particular question as well. So you can see that this one is slightly complicated in terms of where you get the information and the level of detail that they wanted. But in principle, it is not any different from the work that we have done. So that's a good example of a typical question in the exam. Any questions from there? Right, then the other one is, this is now ABC costing. We'll deal with it some other time. Right, for this one, let's hold it right here for the week. So what we'll do next week, we are going to look at cost profit volume analysis. Right, let's look at cost profit volume analysis. Right, I think cost profit volume analysis, if we have 3 hours, we can add another topic again, just to make sure that we push a little bit. Which one should I add? Which one? Right, let me check here your topics for test number 1. I think I did write them down somewhere. I think I wrote them down somewhere, but I don't remember where. Right. So we have CPV, we have, okay, direct, we have standard costing, this guy don't have standard costing. This process costing. All right, so you both have process costing. You both have process costing. Right, joint and byproduct, only the other side is good. That. All right, so let's do process costing. Right, so these are the 2 topics that we're going to have for the next lesson. Right, thank you very much. I will download the session. I will then send you a link, but probably it will come in later in the day. So remember, good people, don't if you are doing the 3rd level modules, it may look like you have a bit of time, but you don't, even though the test this time is a bit far. You need to maximize on test number 1 because you have the most time to do it. So here, what we need to do, we need to finish the syllabus quickly and then sit down and do revision using past tests so that we prepare thoroughly and you get a very good mark on test number 1. What will happen is that after test number 1, the dates for the other test are too close. You won't have as much time. So this is where you maximize, you do your best, you get the highest marks. If there is still plenty of time, we move on with the syllabus. So we go to test number 2 even before we write test number 1, because there will be very little time between test 1 and 2. So if you finish the syllabus and we're starting revision, we can also be adding some topics in test number 2. So that way you can manage the time in test number 2. So don't relax, there is no time. Time is just not there. If you relax, you will see towards the exam that I have made a very big mistake. And make sure that if you are going to come to class next week, cover at least the stuff that we've covered thoroughly. Remember these topics indirectly. When you do cost profit volume analysis, there is no way that you can calculate this without calculating contribution. There is no way that you can do cost profit volume without a contribution. So you need to make sure you are thorough on the previous session so that when you go to the next session now, you are learning the new things. You are not confused by the stuff that we'll be referring back to. And a diligent student at this level, you don't rely on the questions that we've done in class only. When we have finished a topic like this, direct and indirect costing for now, what you do, you go to your question bank. You look for at least 2 similar questions, one for the direct method, one for the indirect method. You attempt and you mark yourself. If you have challenges during the week, you can always give me a shout within normal working hours. Tell me the question that you are struggling with, which particular area we can always discuss. But don't come back to the next class without doing practice. You will fall behind and you'll be in trouble. Right, for today, we are done. Thank you very much. I will see you when I see you. Thank you.
David,
Mhm.
did you share on the group the last weekend class?
Yes, anyone who didn't receive that one, just inbox me. Ne?
Okay, thank you.
Sure. Thank you.